Okay, let's dive right into this. Welcome to today's Explainer, where we're unpacking what is gearing up to be the most highly anticipated, massive, and frankly, unprecedented initial public offering in market history. We're talking about the SpaceX IPO. We're looking at a target valuation that's going to fundamentally shift how public markets operate. But to really grasp what's happening here, we've got to look past the rockets and the flashy headlines and examine the actual financial machinery operating just beneath the surface.
And that brings us to the core mystery of this entire explainer. It's a cold, hard mathematical question. Who exactly is buying into a company that's currently losing $5 billion a year, but is somehow being priced at a jaw-dropping $1.75 trillion valuation? Keep this question in the back of your mind as we go through the data, because the answer, well, it might be hiding right inside your own portfolio.
Section 1. The trillion-dollar IPO. The biggest public offering in history. So, to really wrap our heads around the sheer earth-shattering scale of this upcoming offering, we have to zoom way out. At a $1.75 trillion target valuation, SpaceX wouldn't just be a large company. It would literally be worth more than the market capitalizations of every single American defense contractor combined. Let that sink in. Our sources point out it's basically the equivalent of combining Coca-Cola, McDonald's, Disney, Nike, and Starbucks all into one single entity. That is a monumental figure for any company, let alone one that's never traded publicly before. But how they plan to sell these shares? That's where things start to wildly diverge from the norm. You see, typically in a major IPO, everyday retail investors are allocated somewhere between 5 and 10% of the shares. But SpaceX? They're targeting a massive 30% allocation strictly for retail. The company's CFO actually stated to a room of bankers that this is because retail buyers have been incredibly supportive and are, quote, loyal to Elon. So it's an unusually large slice of the pie being handed to everyday investors right out of the gate.
Section 2. 3 companies in one, inside the corporate trench coat.
Now, what's really interesting here is that to understand this massive valuation, you have to realize you aren't just buying a single rocket company. You're actually buying 3 entirely separate businesses, stacked on top of each other, basically wrapped in a giant corporate trench coat. First up, there's Starlink, the satellite internet division. Second, there's the launch and defense business, which are the rockets most people picture when they hear the name. And third, quietly folded into the mix earlier this year, is xAI, an artificial intelligence laboratory. And as you'll see, these 3 businesses have drastically different financial realities. Let's start with the crown jewel, Starlink. This business is genuinely remarkable. Our sources note that Starlink pulled in $11.4 billion in revenue, boasting over 10 million active subscribers spread across 150 countries. And what's truly staggering here is the efficiency. They're currently operating at 63% profit margins. Starlink is basically printing cash and is widely considered a massive, undeniable success story. Then we have the rocket and defense business. This division brings in a very solid $4 billion in revenue. They're launching government satellites, running cargo for NASA, securing defense contracts, the whole shebang. But as analysts point out, $4 billion in revenue doesn't quite justify the lion's share of a nearly $2 trillion price tag. As one source wryly noted, it's almost like this segment is being valued as if they've already colonized Mars. And here's where we get some serious narrative whiplash. The third pillar is xAI. SpaceX acquired this AI lab in an all-stock deal that valued xAI at a whopping $250 billion. However, the financials show it is absolutely bleeding cash, posting a $6.4 billion loss. On top of that, the founding team largely turned over, and it was publicly stated that the platform needed a complete foundational rebuild. So this entity essentially serves as a massive financial anchor weighing down the rest of the company's profits. So when you consolidate these 3 separate entities, here's the final mathematical reality for 2025. You've got a total combined revenue of $18.5 billion, but it's dragged down to a net loss of $5 billion. Which brings us squarely back to our initial question. How on earth does a company losing $5 billion a year justify the largest IPO valuation in human history? And more importantly, who is lined up to buy it? Section 3. The illusion of control. The retail trap. To find out who's actually buying into this, we have to look at what those buyers receive in return. If you're a retail investor buying into that generous 30% allocation, you get shares. And normally, shares come with a vote. But SpaceX utilizes a dual-class share structure. The founder holds roughly 42% of the equity, but controls nearly 80% of the voting power. Mathematically, this means that even if every single retail investor, and most institutional investors for that matter, completely disagree with a corporate decision, the founder's vote holds absolute dominance. And our sources point to historical precedent to show exactly how this dynamic plays out in the real world. Before XAI was absorbed by SpaceX, Tesla actually made a $2 billion investment into the AI firm. Tesla's shareholders actively voted against this investment, yet it proceeded anyway, bypassing the votes like an unstoppable conveyor belt. When XAI merged with SpaceX, those Tesla holdings were quietly converted into SpaceX stock. It's a crystal clear illustration that for everyday investors in these specific structures, voting power is essentially symbolic. Section 4. Rewriting the Nasdaq Rulebook. The May 1st Pivot.
So the crucial point here is that understanding the company's internal structure is really only half the puzzle. We have to zoom out to the stock exchange itself, because on May 1st, Nasdaq quietly changed 3 highly specific rules. Let's look at the first one, the waiting period for the prestigious Nasdaq 100 index. Previously, a newly listed company had to wait a minimum of 3 months. This allowed the market to undergo price discovery, essentially giving investors a breather to see if the IPO price actually made sense before billions of dollars in index funds were forced to buy in. But the new rule, it compresses that entire 3-month window into just 15 trading days. 3 weeks, and you're in.
Now for rule change number 2, the free float requirement. To be included in the index, the old rules demanded that at least 10% of a company's shares be freely available for the public to trade. SpaceX is reportedly targeting a free float of only 4 to 5%. Before May 1st, this would have been an automatic disqualification. But under the new rule, that 10% minimum has simply been completely deleted. But rule change number 3 is without a doubt the most alarming. Buried deep in the technical language is a brand new hidden multiplier. If a company has a free float under 20%, Nasdaq will now treat that float as 3 times larger than it actually is when calculating the index weight. That means SpaceX's 4% actual float is treated as a 12% float inside the index methodology. This magically generates phantom shares that quite literally do not exist, completely altering the supply and demand math behind the scenes. Let's move to Section 5 and see how this all builds up. Your retirement exit liquidity. The squeeze on Main Street. You see, these highly technical rule changes aren't just Wall Street trivia. They directly impact Main Street. They impact you. Here is exactly how the mechanism snaps shut. Step 1. The fast entry rule drops SpaceX into the Nasdaq 100 in just 3 weeks. Step 2. That hidden multiplier artificially inflates their float within the index calculations. Step 3. Because the Nasdaq 100 is tracked by over $600 billion in passive ETFs and index funds, those funds are legally required to buy the stock automatically to match the index. And Step 4. Who owns those passive ETFs? Yep, everyday 401ks and retirement accounts. By deleting the minimum float and adding that multiplier, the exchange has essentially built a mechanism that forces massive passive funds to blindly buy an unprofitable company at a peak hype valuation. As financial experts like portfolio manager George Noble impartially observe in our sources, the math points to one very sobering conclusion. He says, quote, "Your 401k is the exit liquidity. Insiders and early investors hold the vast majority of shares at a very low-cost basis, while the structural rules force regular retirement accounts to buy in at a nearly $2 trillion valuation." The brilliance of passive investing was always that you could just set it and forget it. But the very feature that makes it so convenient also makes you a guaranteed automatic buyer for anyone who can squeeze their way into the index. The rulebook was quietly rewritten, and the insiders are perfectly positioned for what could be the largest wealth transfer event in market history. So the only question you really have to ask yourself now is, are you? Thanks so much for joining me on this explainer, and I'll catch you next time.